Treasury Secretary Steven Mnuchin denying any negative economic impact yet due to the tariffs. Automakers do beg to differ, though. They have already come out pretty much screaming that tariffs will push up costs and hurt business and lead to the loss of thousands of jobs in what they perceive to be a domino effect. The nation's farmers are also caught in the crosshairs. The Department of Agriculture, the administration's Department of Agriculture, says profits are at some of the lowest levels in more than a decade. And even the North Carolina steel producer you may have never heard of helped construct the Statue of Liberty scaffolding. He says he's getting killed on higher raw material prices. In his first interview since Steven Mnuchin made his comments, we have Allianz Chief Economic Advisor Mohamed El-Erian. Good to see you, Mohamed. All right, who's right here, Treasury Secretary Mnuchin or the companies that source materials from China and elsewhere to manufacture and sell their products to Americans?
They're both right. First, tariffs have winners and losers. When you change costs and prices, when you change demand, some people benefit, some people lose out. So the companies that are being hurt are being hurt. Secondly, they're both right for a different reason. Secretary Mnuchin is saying as of now, he has seen no impact on the overall economy. It's still early days in this tit for tat on the tariff side. The concern is not as of now. The concern is what happens in a few months' time if we get a further escalation of these trade tensions.
Okay. Let's talk about individuals who purchase these products, not just the companies. We had this report out of the London School of Economics and Princeton University, and they're in essence saying it's just I hesitate to say just. $60 is a lot to a lot of people in America, but so far a $60 impact per year per family. Could that rise if we see the Chinese threaten tariffs that the president just announced? It's 205 pages of many, many, many products. If those come to fruition in reality, could that change and worsen?
And that relates to the question, Liz, which is fundamental, and the market has taken a view on this. Is the current stage of trade tension a means to a better end, and that better end is still free but fairer trade? Or instead, is it an end in itself? Are we simply going to see more and more and more trade tension, which means a full-blown trade war? I think it's the former so far. Okay. I think the market is right in assuming that this is part of a process, and that ultimately, because all parties have so much to lose from this, is going to focus minds, and you will get a better outcome.
Our viewers are one party that are watching very closely here. They have portfolios, they have 401ks, people with 529s, pensions. Tell us, Mohamed, what you see for the markets as it pertains to either impact from this or even, I don't want to ignore the so-called flattening yield curve. We started to look at this morning in our countdown meeting. We have this editorial meeting in the morning and said, my goodness, across the entire level, the 2, the 5, the 10-year, the 30-year, they're all higher than 2.5%. I think the 10-year yield right now is just 26 basis points higher than the 2-year. Which one has potential to impact a portfolio, and in what direction?
So if this were normal times, you would look at a 26 basis point difference between the 2-year and the 10-year, and you say, wow, that's extremely low. And what has that signaled in the past? It has signaled a slowing economy. And what does that mean for stock prices? It's not good news. But these are not normal times. Let me give you another indicator. Look at the difference between the 10-year in the U.S. and the 10-year in Germany. That is now at 255 basis points. That's really high. And what it tells you, Liz, is that the longer end of the yield curve is being depressed by what's happening overseas and by technical demand, by non-commercial players. So your viewers shouldn't worry about the yield curve. What they should worry about is, one, is the market wrong in assuming that the trade tensions will not result in a trade war? And two, that we see increasing divergence. The U.S. is growing solidly and will continue to do so. The rest of the world is facing a lot more headwinds.
Yeah, the U.S. economy looks very good. The jobs market is very tight right now. One quick question, though. Would you advise viewers to go into maybe the shorter end of treasuries?
Yeah, I think the shorter end of treasuries are relatively safe, and finally, they yield something that's acceptable. For a long time, they were yielding nothing at all. So that become a good place to keep some of your dry powder, if you like. In terms of how to deal with the trade tensions, I think that if you believe that if that's the only issue stopping you from investing, and it shouldn't be, but if that's the only issue, then you should do what you did earlier, which is you should take advantage of these flash corrections. But there are more issues. So the key issue is to respect dispersion in markets.
You know, I coined that term, flash dips. I need to trademark that.
You do.
Mohamed, great to see you. Thank you so much for joining us.